So we begin with our top story, strategists pushing back against the end of the cycle narrative.
The cycle still has some life in it.
It can continue for a long time.
The central bank in the US and elsewhere, of course, are likely to extend this cycle further.
Extend the cycle by getting off that train of automatically hiking rates.
If it's high real Fed funds that's really going to be tipping the economy into a recession or being a key factor for that, we're not there.
This is a mid-cycle pause.
There's mini decelerations, there's mini scares.
It's maybe the third mid-cycle pause, but it's not the end of the cycle for us anyway.
Maybe growth recessions, but not outright recession.
The world is not as cyclical as it used to be.
Maybe at the middle of the year we might be having something of a rethink when we see that actually the sky hasn't fallen in completely.
Within months, we're going to be talking about global synchronized stimulus and then global synchronized recovery.
Giving up on stocks at this point in the cycle seems to be, again, not something we would be recommending.
To continue the conversation, joining us around the table, Jim Caron, Morgan Stanley Investment Management Global Fixed Income Managing Director, Binky Chadha, Deutsche Bank Chief US Equity and Global Strategist and Head of Asset Allocation, and Gina Martin-Adams rounding things out for us, Bloomberg Intelligence Chief Equity Strategist. So, Binky, let's begin with you. The overwhelming consensus is we're not at the end of the cycle. This can continue. Is that your view too?
Absolutely. You know, I would keep things that have happened basically over the last couple of weeks in perspective, and maybe it's 3 weeks since the ECB. You know, the central banks are saying they're going to be easier, and so the markets have responded by pricing out, you know, the time of normalization, or in the case of the Fed, you know, we've moved basically from a message of 2 to 3 rate hikes basically to, you know, now pricing in 1.5 rate cuts. So market pricing of what the Fed is going to do has changed. That's, you know, inverted the yield curve. That's, you know, a market price variable. It's not really telling me anything about the economy.
Gina, the signal that some people take from the bond market has shifted as well. It used to be a source of comfort, yields are low. Now it's a source of fear. Why are they so low? What do you tell clients at the moment?
Well, I think part of it is just keep in mind that the bond market signal is one of many signals for the cycle, right? We have an 11-factor checklist, for example, that we look at for the equity market. The bond market comprises 3 to 4 of those factors, but you also have macro indicators, you have earnings indicators. There are a lot of things you want to watch for signs of an equity market top forming. I do think in the short term, a lot of these things detached and do suggest that we're in for a period of at least consolidation, if not near-term weakness for the market. But is it a sign of a top that we're turning over into some really ominous recession? It seems unlikely. And I think we're forgetting the fact that we had a 20% correction last year. So the market already priced in a considerable amount of weakness in the first quarter. Yeah. Yes, we have bounced back really quickly, and we may start to question the durability of that bounce back, maybe give a little bit of it away. But we priced in a lot of weakness last year, and we have to keep that in mind.
Well, Jim, you think we need to price in a little bit more into the Treasury market. 225 on a US 10-year would have sounded absurd a couple of months ago. Now it sounds realistic. It's your call.
Yeah, so look, I mean, there's no mystery around this. I know there's sticker shock, but it's just math. So the long-end rate is really path dependent on where short rates are going, right? So if the Fed tells you that they're pretty much out of the market for the next couple of years, I don't believe they're going to hike rates in 2020. And then ultimately, if there is a slowdown a few years later and there's a recession, the 10-year yield is really just the overnight rate rolled over every day for 10 years. So if you're telling me that the short rate path is going down, it's going to drag down that back end rate. Now, what the Fed is also telling you is that they're not willing to call for the end of the cycle. So we're talking about recession. End of the cycle means start of the recession. So if I'm not prepared to call for the start of a recession, then I'm not prepared to say that we have an impending end to the cycle. And what the Fed is effectively doing is they're trying to extend the cycle. They're not trying to end it.